At Metropole TVKE across all your social media platforms. My name is Simba Elijah Charles Kiage. This is your economic review. Welcome to the official broadcaster this morning. We're joined by Tommy Randall and Gabriel Mwendwa. We're going to take us for the next couple minutes as we decipher the biggest headlines that you're waking up to this morning. First one being Treasury now projects that the government's spending will jump by 200 billion over the 2022-2023 financial year as a result of the general election. The country now plans to spend 3.228 trillion for the next financial year, representing a 16.5% increase from the current expenditure. Treasury plans to raise the funds through the Kenya Revenue Authority (KRA), whose target has been set at 2.14 trillion, 18.7% above the target for the current financial year. That stands at 2.03 trillion with a total revenue for the 2022-2023 financial year, including funds collected by government agencies or appropriations in aid, expected to reach 2.41 trillion shillings. Treasury plans to allocate 675 billion to development expenditure and 4.065 billion to counties. Now, the budget deficit has been projected at 775 billion, 16.5% lower than the 929.7 billion for the current year, and will be financed through foreign loans, both commercial and concessional, amounting to 367.8 billion, and domestic borrowing of 408.1 billion shillings. Good. Just before I invite Tommy and Gabriel this morning, let's look at this data set that we have for you this morning so we can look at exactly where we are. Now, KRA is the one that has been given that biggest mandate for collecting again in the financial year 2022-2023, and you can see exactly where the total exchequer revenue trend has been from 2015 all the way to 2020, standing at 1.5 trillion, and at 2019-2020, with the only good news coming in from 2020-2021, when the bid KRA reached the mark or their target and actually eclipsed it with a couple of billions, which actually saw them get that bonus in terms of their pay rise. Now, let's talk about the next one this morning that we're saying. Now, the composition of the recurrent expenditure, because that is exactly what KRA is telling us this morning, that majority of that expenditure, again, is going to go directly into the payment of those salaries by IEBC. Now, you can actually see where we are. Domestic interest at 23%, foreign interest at 8%, wages and salaries, the biggest chunk yet, and we expect that to rise again in a 2022-2023 at 31%, pensions 6%, with the others coming in at 32%. Good. Let's cross over to the next one again. If you look at where we are then in the general Kenya government recurrent expenditure, which is bound to take the bigger chunk of that 200 billion shillings rise in expenditure, we are at 2021, we dropped it down a bit to that billion, but then again we expect that this is going to rise. But the general trend, you can see all the way from 2015 to 2019-2020 was rising. We tried to correct it, and at 2020-2021, but that correction is going to be wiped off in 2022-2023 by that expenditure by IEBC that's going to go pretty much into wages and then salary repayments, and also improving the capacity of IEBC to conduct that election. Crossover again to the next data set that we have for you this morning. Now, indeed, we are saying that this expenditure is sort of anchored on the economy responding to around 6.2% growth in a 2021 2022 period, which the same one they're saying would extend into 2022-2023. But the question is going to be, these 6.2 numbers that we're talking about, you will see in 2017, especially when we're approaching that election period, we were at 5.2 in 2017, and we actually came all the way to 4.9 again. And at 2020, we did see as actually get into that recession when our economy experienced a negative 5.7% growth in a quarter one of 2020. A question that's going to be, if indeed we are going to rebound to 6.2%, what must happen here for us to get back to the 2018 levels? Because that's exactly where we were in 2018, with our biggest one being quarter four of 2018, where we experienced 6.5% growth. When we're nearing the general election, does it mean that this time we're overly optimistic about that growth number that the Treasury is anchoring on to give Kenya the biggest target yet, 2.14 trillion? Fantastic. That's where we are. Let me cross over to Gabriel this morning. Gabriel, a 200 billion shillings increase in our expenditure in 2022-2023 financial year. Is it inevitable, Gabriel? Could we be talking about a lesser expenditure?
That was the hope, that we will be getting a lower expenditure budget. But like I said, I think something that should not go unnoticed in this budget, that the deficit is actually lower.
Yes.
I know this is not the final one. That's going to change. But, ideally, from an economic standpoint, what you really look at is the deficit. Even if you have a budget of 5, as long as you can fund it, from whether it's your revenues or other sources, then you're not badly off.
Yes.
So the problem is always the deficit. So I think we owe a small one to Treasury, or at least bringing down the deficit. Now, on the expenditure side, I think given a few points, it's because of in the recovery period, still dealing with COVID as well as the election. So, and of course, quite a bit of development expenditure. Given the change in guard that we are expecting with switching presidency, I would have expected a slightly lower development budget, because you don't want to start things and then, the projects are left hanging because of the change in guard, because of how bad our politics is. People don't continue with what you started. And then again, we know a lot of our corruption is linked to development at the moment. So that means, that big jump in development might result in a few leakages.
Yes.
Due to rash. So, big mixed feelings for me as far as the expenditure was. Good on the deficit reduction, but I'm worried about the very large development expenditure. While we are looking for a recovery budget, we should be looking at the small, expenditures that would give us a bigger win.
Yes.
Because the highways, SGRs for the last 10 years have not given us much.
Gabriel, just before I cross over to Tommy this morning, Gabriel, yes, you are celebrating that budget deficit, but Gabriel, let's not forget that if you look at what they're projecting the economy to go to, so that now we can actually start putting these factors together, even if how they've calculated that budget deficit, they're saying that we are bound to jump to 6.2% growth. Let me go back to that data this morning. If only we could jump into that GDP growth rate so we can actually track it and see exactly where we were. Gabriel, if you look at that, at 6.2, the only time we say it was in 2018, and we're talking about quarter one of 2018, went all the way to quarter four of 2018, where we jumped to 6.5. In quarter three, we were at 6.6. But now, if you go back to 2017, Gabriel, when we're just in the electioneering period or approaching that electioneering period, Gabriel, you will say we started at 5.2 in quarter one, and then quarter two, we went to 4.4%, and then in quarter three, we went to 4.5, quarter four, 5.1. Now, Gabriel, put COVID-19 in that mix of the electioneering jitters, and then Treasury comes and tells us we are projecting that in 2022, 2023, we're going to get back to 6.2%, which makes us question, Gabriel, how? It's never happened. All the way from 2017 up to where we are right now. In fact, you go back again to the electioneering periods, you're going to see that's when our quarterly numbers drop the farthest. So this budget deficit, is it as inaccurate, Gabriel, as it can get?
So you're very spot on the math and what we would expect. You know, as far as the historical numbers tell us. I mean, spot on.
Yes.
I think what you're missing is that the government, you and I don't know what our GDP is. So they are the only ones who know what they're growing from, what they're growing to. Simple as that. If you do the math based on the percentages that are presented in this budget document, the draft one, you'll see that they're saying our GDP is 13 trillion. Now,
yes.
Simba, look at all the documents and data that you have. Are you seeing anywhere 13 trillion that Kenya has ever achieved? No, we've never seen a proper growth 2019 to 2020 until we go to 13 trillion. So how are we getting to this 13 trillion? It's only them who know what they're going to do to achieve this 6.2 growth. So your analysis, like I said, is spot on. You know, we expect very slow growth in that Q3, Q4 period. That is going to come whether government does what or what. But remember again, a big contributor to GDP is always government expenditure.
Yes.
So you need to factor in their expenditure, GDP as well. So it's not only the economic activity between you and I, which is real economy. Also, government expenditure is a key component in GDP. So that, I think, is going to contribute to some growth.
Yes.
And then again, as I've said, we don't know what we are growing from in terms of numbers. So that's the other thing. They have that cut up the sleeves.
Pretty much. Tommy, let me bring you in as well this morning, and good morning. Tommy, let's look at that. Gabriel is saying that if you look at that 675 billion that they've awarded that development expenditure, it would have expected it to be a bit less than that, because then with the change of guard, somebody might come in and say, I don't recognize this expenditure plan for this government. Now, if you trace that development expenditure, you will see that all the way from 2015, it has been hot and cold, especially with the way the government has sort of spent on its development expenditure. They've been hitting it left, right, and center. And obviously, the least one that we're talking about here is in the current financial year, 2020-2021, which has the least development expenditure. But then I was short again to 675 billion in the last year, that 2022-2023. Do you agree with Gabriel that indeed they should have spent less on that, or just approach it the way they are?
There are two ways to look at this, Simba.
Yes.
You look at it from an economic perspective, where you would want the development budget to be less.
Yes.
Because of those factors such as handing off. But also from the point of view of the current administration, they want to finish off their projects quickly so they can have something to tout during election. So that would be the reasoning I would think that the current government is using to allocate more money for the development budget.
Let's look at that another area as well that told me this morning. KRA has been given a target of 2.14 trillion, their biggest one yet. Tommy, when you look at the way in which KRA has been collecting their monies, we did celebrate them breaking that 8-year jinx in the financial year 2021, in the financial year 2020-2021. Are we moving closer then to that period where we're saying KRA can actually meet their targets, so we start to have a more accurate document that leads us into a financial year?
I think that, first of all, the GDP number is a little bit too optimistic.
Yes.
And if that's the number KRA is basing their target on, then it's highly unlikely that they will get to that. There's a report called the Analysis of the National Government Budget Implementation that urges the current government to have more realistic projections when it comes to GDP. And also, one of the key things that it suggests is the development budget should be lowered. But KRA, if they keep up with the trend that they did over the last quarter, maybe they can make that budget. I personally don't see it happening though.
Right, Tommy, somebody would ask you, how should this government approach the last financial year?
I would say approach it with a lot of caution and do it from a fiscal irresponsible, a more conservative approach when it comes to those numbers.
Yes.
This way the projections can be a little bit more realistic.
All right, Gabriel, let's tackle that question by KRA as well, because then if you're going to increase your expenditure, you do expect that you're also going to increase the target for the Kenya Revenue Authority. They have the biggest one yet. Should we question, Gabriel, increasing KRA's target at a time when we do know very well that the economy goes through jitters, therefore reduce business activity within the economy?
I think, Simba, I don't think they are off in terms of their projections with KRA government revenue, given the policies that were introduced in 2020 or 2021, mostly
Yes.
actually. So, for example, the VAT on LPG, etc. You introduce the policy, it takes time to get all the players in place. So, I'm thinking, that might be the time when they are getting most of the players on board. So, maybe they are banking on policies that were already introduced in 2021. First of all, because once you introduce these policies, you have a negative dive, and then you start picking again. Remember, we have the minimum tax law in court. So depending on how that plays out, those are some of the policies they might be looking at. Again, we will have a finance bill. We have already requested for comments from all players in the industry. So, we are waiting for that as well to see where the government is going to get in that additional revenue. It's not exactly a big jump, but it's a big jump given the previous misses of targets that KRA has had. But I won't put COVID at the center of whether we hit it or not.
Yes.
I'll base it more on the tax policies they bring on board. Hopefully, there are more to, of course, assist the economy recover, etc. But we already had a raft of tax measures brought last year that are going to come back. And then again, I'm forgetting the timeline, but if you could check with your side, when was the VAT for fuel to be reviewed? Remember, they gave us 8% for a certain number of years. It was going to be reviewed up. So I'm suspecting it might be 2023, but I'm not sure in my head when that was supposed to be reviewed. So that's another thing to look out for.
Yes. Gabriel, lastly, therefore, as we step out of this subject of KRA, remember that they've missed their targets all the way to 2020, 2021. But then remember again, that target that they had in 2020, 2021 was revised downwards as a result of the coronavirus pandemic. So is it not, therefore, Gabriel, common sense that really when you increase it, they're going to go back to where they were?
Yeah, it's likely. Honestly speaking, missing that target has been done. This one. Then we already expect there to be an increase in the deficit. So,
Yes.
If you ask me, I have to look at the historical figures again, but yeah, we expect that deficit figure to increase. So thankfully, there's a big drop in the deficit number. So if KRA misses, there's some room to increase that deficit without going back to where we were previously. So yeah, I think even for them internally, they do plan for a miss.
Fantastic. All right, gentlemen, let's move on to the next issue that we have for you this morning, where the latest half-year results by the majority of the lenders in the country show that Kenya's top 9 listed banks cut their provisions for loan defaults by a third in 6 months to June. An analysis of the top 9 banks in the country shows that KCB, Equity, Cooperative, I&M, Absa Bank Kenya, NCBA, Standard Chartered Bank Kenya, DTB, and Stanbic Holdings all reduced the provisions from 40.13 billion booked in June last year to 26.68 billion, accounting for 13.45 billion or a 33.5% cut. That's huge. Now, the 9 banks saw their net profits rise by 27.8 billion to 66.49 billion, which was a clear indication that the lenders had fully come to terms with the effects of the pandemic, with their net tax profit for the 2019 half year taking to 54.68 billion. Central Bank of Kenya data indicates the commercial banks in the country raked in 96.4 billion in profits before tax for the first 6 months, which was an all-time high in the period going beyond 2019's 85.5. 1.7 trillion was restructured by commercial banks in the country, accounting for 57% of the banking sector's gross loans between March last year and February 2021, when the emergency measures came to an end. Let's look at that data set that we have for you this morning. That's going to give us where we are in terms of the performance of banks in the first 6 months of this year. And you can see when we're looking at that in terms of gross non-performing loans, all the way from the first half of 2017 to the first half of 2021, yes, you can say that indeed it has been rising, and you can actually trace that data from Q2 of 2017, and then you come all the way to around Q2 of 2020 again, when we jumped as a result of the coronavirus pandemic. But then we are flattening that curve as from April to May and June, according to this data that we have for you here, and now we are talking about that being at an average of 14%. But the Central Bank of Kenya being optimistic that that number will continue to come down as the year progresses, which is exactly why majority of the banks in the economy have reduced that provisioning for non-performing loans, and they've cut it down by 33.5%. Huge margin. All right, let's cross over to the next one. Let's look at the Kenyan banking sector. Selected performance indicators in the first half of 2021. I will say one thing. When you look at this data, then you're going to say everything is pointing northwards. It's an increase all the way from January 2021 to June 2021, and you can see that in terms of gross deposits, which have gone up, gross loans gone up, profit before tax is gone up across the board. All right, let's cross over to the next one as well that we have for you this morning. If you look at the total liquidity ratio in terms of the average one, then you will see that all the way from January 21st to June 2021, then you can actually see that that liquidity ratio average is on an increase. And we apologize for us lacking the figures on your y-axis there. We shall be indicating them as soon as we get them. All right, Kenyan banking sector total assets as well in the first 6 months of 2021, again going up. And I want you to look at that figure from March 21st all the way to June 2021, really showing you that even in terms of the asset basis of these banks, then that area is also pointing northwards. Fantastic. That's how it looks. Looks as if things are not bad for majority of the lenders in the economy. Now, Tommy, question is going to be, if you look at the way these bigger banks then have reduced their provisions for non-performing loans within the economy, is that an indication that indeed, when it comes to the banking industry and the economy at large, things are back to normal? Is that what it's showing, Tommy?
We're heading to normal. We're not at normal yet, and people have a more rosy economic outlook of the future.
Yes. Look at that figure, 33.5% reduction, especially for the big 9 banks in the country. Is that not enough then for them to say, well, we are quite optimistic now that should we give out money into the economy, there's no need to provision for it to higher levels. We are going to get a proper return on that investment. So you say we are not yet there, but it's an indication that we are there. But that percentage, Tommy, is it not enough to say, well, they've assumed things are back to normal?
I mean, it's definitely good for the banks and the shareholders and people who would like to borrow money in future, but
Yeah.
we're still not quite there because there are certain aspects of the economy that are not fully back to normal. Let's look at tourism. That's still at a low. The most recent thing is now matatus being allowed to carry people as a whole. That helps a little because all that money goes in and out of banks. People are able to pay off their loans. Less people are defaulting, and most majority business holders do not want to default on their loans because they need running capital, which they require from the banks.
Fantastic. Gabriel, let's look at that as well. 33.5%. We do have now the non-performing loan book in the country at 14%. When you look at those figures, they've reduced that provisioning by 33.5%. The non-performing loan book in the country is at 14%. So when you look at our margin, Gabriel, is it an indication enough that the banking sector in the country right now is quite optimistic that indeed the economy is back up and running?
I think it's a mix of two things. It's not just about the economy; it's also about the internal policies as well. Because then they have the target provisions. So it's not only the provision you see in the sort of income statement. If you look at the additional information they provide, they give you the sort of the loans which need to be provided for, and the total value of their provisions. So some banks always say we want our provisions to be 50% of all the loans that are at risk.
Yes.
Some say 50%. So that's really what drives the provisions. So in 2020 and maybe the first part of and some part of this year, they have made high enough provisions to actually cover them. So in last year, if you look at the provisions they made, they actually, hit whatever number in terms of provisions they want. And because their loan books have actually not grown significantly, I did not expect to see a big jump in that provision.
Yes.
Because it's also, if already in 2020 we provided for our bad loan book and we've not grown our loan book significantly, as you will see with most banks, then it means there's not much to provide for. So yes, 14 is not a very rosy number, but I think if you look at even the big banks where most of these bad loans may sit, the provisions, even as at December 2020, were rich enough to cover for them. So unless there's another big shock, I think they already did the provision. So the economy aside, they already made that provision. Again, the companies that were not doing so well maybe have come back, or companies have re-strategized. The ones which were needed to scale down have scaled down. So the banks are now more comfortable maybe with their clients' position. They understand where their clients are, whether good or bad. They understand and they know what needs to be done for the next few years. So maybe they are taking some comfort in that.
Yes. All right, Gabriel, just before we get out of this subject this morning, there's another area that I want us to interrogate this morning so we actually get to understand it. If you look at that liquidity ratio for majority of the banks in the country, has been on an increasing trend, especially all the way from January 2021 to June 2021. Despite that increasing, you will see that indeed their provisioning has also been cut. How do we understand those two variables this morning, Gabriel?
So, if I'm to get you correctly, you're comparing the provisions together with the
liquidity ratio of majority of these banks, yes.
Yeah. Okay. So I mean, the liquidity ratio is a factor of course, their growth in their assets. So and I think this has actually been maintained since late 2019. Very high liquidity ratios because even in 2019 the banks are not lending that much to the economy because we consider even part of their government holdings as part of liquidity ratio. So in short, the banks can meet their short liabilities. That's one. Two, the banks can actually support their existing customers substantially. So if you have a big customer who needs additional funds to get all, the banks are able to help. So that liquidity ratio just gives them a lot of room to generate more money for their shareholders, whether it's putting it in bonds or wherever. That's how I look at it, because the provisions are really a factor of profit, not necessarily your balance sheet.
Yes.
But they can really increase their loan book. If there are good assets in this economy, the banks will increase their loan books comfortably. I think that's how I look at it.
Yes. Is it also an indication that the banks still coy to just let it go fully to the economy in terms of lending?
Yeah, definitely. I mean, banks are more keen on the budget, so
Yes.
they might not be happy with the deficit being low, because that means, I mean, the amount they are going to lend to the government, I don't think will change. Last year, it was around 400 billion, but they're not lending to the economy. That is very straightforward. We see their salespeople left day. We see the corporate bankers looking for business, but in terms of deploying money, they're being very picky with their assets they're protecting. So still not lending to the economy as would.
Pretty much. All right, Tommy, let's clear this in 45 seconds, if you may. If you look at the way in which the majority of the banks have performed in the first 6 months of 2021, is it an indication of the general performance in the financial services sector?
Like Gabriel said,
Yes.
banks have revisited their policies on lending. They've come to terms with the situation. They know who is credit worthy and who isn't, and they have the money to back up any loans that might be required by their best customers. So it mostly has to do with the banking policies changing. That would be my opinion on that matter.
Fantastic. All right, gentlemen, we take a short break, but once we come back, there's a big question in the room. Now, how is that the loans that are extended to higher education seekers in the country, both private universities and public universities? Now, if you reduce the interest rates charged on these loans, it means that the amount of money, indeed, that then you would get by these seekers of these loans taking these loans would reduce in the long run. But then, if you increase it or retain it at 4%, it means that within a period when you're lending at 4%, your return is high enough so you keep on acquiring more students who can actually benefit from the health loans in the country. Now, there was a petition seeking a change to that specific bill, but it has been shot down. Question this morning is, if you increase interest on a loan, do you get more people on it, or do you get less people on it, depending on the income that you want to get from this specific product? Once we come back here on a Metropole Television at Metropole TVKE across all your social media platforms, my name is Simba Elijah Charles King.